This lecture covers bonds, but before we get into the details of bonds and bond valuation, let's review the two major sources of funds or financial capital for a business activity. They are equity, which are owners' funds, the amount that the owners have invested in the business activity, and debt is borrowed funds. Now, to understand these concepts of equity and debt better, let me go ahead and draw a balance sheet. And the reason why I like to use a balance sheet in illustrating the business activity is because it gives a good concept of business activity at a point in time, and I like to use the T account form of the balance sheet to illustrate the idea of the balance sheet actually balancing. The assets over here on the left-hand side are supposed to equal the liabilities and owner's equity over here on the right-hand side. They're supposed to be equal there. So let's say that the owners, we have the equity holders or owners of a particular business activity, want to invest $50,000 of their own funds into the business activity. This is the equity portion, the investment from the owners, or simply one owner. Now this could be in the form of, this business activity could be in the form of a corporation, limited liability company, partnership, or whatever. But although we may have different forms of equity, the relationship between equity and debt is still the same. Equity has a residual ownership claim in the business activity, while debt is a contractual obligation of the issuing company, of the issuing business activity, that must be repaid according to the terms of the contract. And that would include paying interest and the principal amount. So while the equity receives whatever is left over, it's a residual claimant. So we're concentrating over here on debt. The equity holders may invest $50,000, and let's say that the business activity borrows $50,000. So these are our major components of our sources of funds, or our financial capital, that is debt and equity. The debt here may be short-term or current liabilities or debt. So we're looking at debt here. That's the liability part there. It could be bank loans. And this short-term debt up here may include something like accounts payables. And then we have bonds. Bonds are a form of debt, and it can also be in short-term, intermediate term, or long-term debt. And so debt holders are investing $50,000, equity holders are investing $50,000, and so we have a total investment in the business activity of $100,000. And so the assets over here on the left-hand side are going to total $100,000. It may be $100,000 in total in cash initially, but then that cash could be spent on different things. Let's say we have a lawn service business. It could be in the form of equipment. We're taking that cash and we're buying equipment, trucks, mowers, rakes, and so forth, an amount of gas, and some of it could still be used as cash. But whatever, we have a total amount of assets over here of $100,000, and the $100,000 in assets is coming from the $100,000 invested by the borrowing over here, the debt holders, and the equity holders. So we want to concentrate on this bonds part here. Bonds. A bond is a form of debt. It's an IOU. Generally, it's a debt instrument that obligates the issuer to pay back the amount borrowed, that's the principal, okay, plus interest. So it's a form of debt. It's a debt instrument. We can also call that a debt security, and the reason why we're calling it a security, we can call that an equity security, or regarding equity in regards to shares of stock, or we can call bonds a debt instrument or debt security because it secures a claim on the issuer. It's a debt claim or a debt security. Now, bonds are a type of fixed income investment, a fixed income security. And what do we mean by fixed income? It's simply a fixed income security is simply a security of an entity that promises to pay a fixed or specified amount of money at a specified time in the future. And it would include preferred stock. Now, preferred stock is a form of equity, but it includes a fixed dividend stream. And bonds, since they include a fixed interest stream, usually, either a fixed dollar amount or a fixed method of calculating that dollar amount, bonds are considered a fixed income security. Generally, though, fixed income, when we're talking about fixed income securities, that's usually equated with bonds. So fixed income securities and bonds are usually used interchangeably. Let's look at an illustration of a bond issue. We're going to make it very simple. We're going to use our little stick figure men here. And so this is the issuer. And the issuer could be a particular person. Usually it's a corporation, some type of business activity. It could be a government entity or a government agency. This is the issuer. And the issuer, we're calling this particular entity the issuer because it's going to issue the bond. And we're going to represent that bond as a piece of paper here. There's the bond. And the bond is issued to the investing public, and the person buying the bond here would be the bond holder. And the bond holder is the person lending funds to the issuer. In exchange for the bond, the issuer receives an amount of funds. So the bond holder here, the person buying the bond from the issuer, is lending this amount of funds, and so the issuer is also the borrower of those funds. The issuer of the bond is the borrower. The holder of the bond is the lender. Now we want to look at a few features of the bond, and I wish I kind of drew this a little smaller. Let me do it this way so we can kind of look at that picture to get an idea of what we're talking about. But we need to look at the bond features such as the principal amount borrowed. The principal. So if we're talking about a loan, the amount that's borrowed is the principal, and that principal must be paid back with interest. The principal for a bond is usually termed the par value or face value, sometimes also referred to as the maturity value or redemption value. And then we need to consider the interest that also must be paid on top of that principal. And that's called a coupon or coupon payments. And the coupon payments are calculated as a percent of par. And as a percent of par, we call that a coupon rate. CPN short for coupon rate. So for instance, the principal or par or face value amount may be $1,000, and the coupon payment would be, let's say, $100. That would be a 10% coupon rate. 10% of the $1,000 would be a 100% interest payment. That would be the coupon payment. Now in the U.S., coupons are usually paid every 6 months or semi-annually. Mortgage-backed securities and asset-backed securities, in other words, other types of bonds in the U.S. may pay monthly, but most corporate bonds and U.S. government issue bonds are paid semi-annually. Now, some bonds, usually those outside the United States, pay coupons annually. Another feature that we need to look at is the term of the bond. The term is the time period of the debt. It's the term, when we're talking about term, we're talking about the term to maturity when the bond matures. And that's just the life, that's the life of the bond. And so the maturity date would be when the bond ends, when it ceases to exist, when it's going to expire. That's when all the principal and interest payments are to be repaid. We also need to specify here the bond indenture. The bond indenture is the contract between the issuer and the bondholder, and it would include promises of the issuer and rights of the bondholder, and some of those promises and rights would include the promise of the issuer to pay interest, and also it may include obligations imposed on the issuer by the bondholders, such as limiting the ability of the issuer to issue additional debt or take on additional debt when they can pay dividends and so forth. And those obligations imposed by the bondholders, usually called covenants, are there to protect the bondholders. And also usually there's a third-party trustee specified in the indenture that represents the interest of the bondholders and looks after the affairs and makes sure that those promises and rights are upheld, those covenants are kept. Now let's illustrate the cash flows for a bond. Let's look at a bond that it's an 8% bond with a term of 3 years. When I say 8%, what I'm meaning is the coupon rate is 8%. And this is going to be paid, remember I said this could be paid monthly, semi-annually, annually. Let's say for simplicity it's going to be paid annually. The par value here for this example will be $1,000. And the term, let's say, is 3 years. So let's draw these cash flows on a timeline. I'm going to draw a 3-year timeline here, starting with 0. And then I'm also going to specify the cash flows in relation to the issuer. Let's draw a little man over here. This is the issuer. If I make him a little smiley man there, he's issuing because he's about to borrow some money, so we can use that to make more money. We have the issuer, and the issuer then is going to issue the bond, sell the bond to the bondholder. And this bondholder, let's put a smiley face on him because he's just loaned some money. He's expecting to get a good return in the future there from these cash flows. And so the bondholder is going to pay, and I'm going to put as a negative cash flow, these little brackets again, the price of the bond. And that's given to the issuer, and this is a positive amount to the issuer. The issuer receives the price or the issue price of the bond. And then the bond will be paying out coupons and principal payment of $1,000 to the holder. Let's first look at the coupons that will be paid out to the bondholders. This is an 8% coupon paid annually, and so the coupon, the actual dollar value of the coupon, is equal to 8% of the par value of $1,000 here. And that gives us $80. And so the issuer will pay out at the end of every year $80. That's a negative amount to the issuer. And then when the bond matures, the par value is paid off. That principal amount there, the par value or face value, is also paid off. So the issuer is paying out $80 in year 1, $80 at year 2, and a total of $1,080 at year 3, 3 years from now. And those are received by the bondholder. And so these payments here, this is what the bond promises. The bond is essentially saying the issuer is agreeing to pay you $80 every year for 3 years, and then $1,000 3 years from now. That's the IOU, and that's what the holder is buying there. And this is what these are the cash flows that the issuer is obligated to pay. Now, let's discuss the price of the bond here. What the issuer can receive and what the holder is going to pay. That depends on the supply and demand of bonds in the market, and is simply determined by the value now that is placed on all these expected cash flows. So what we're looking at here is, what's the present value of that cash flow stream? The price of the bond is the present value of the bond's cash flows given a discount rate determined by the market. Let's look at our view here again, see if we can zoom. Oh, it's still at 75%. Make that even a little smaller there. And so we need a discount rate to discount these particular cash flows. What cash flows are we looking at here? We're looking at the payments by the issuer to the holder. We have basically 80, 80, and 1,080. So the price here would simply be the present value of those expected future cash flows.